No one has said this since morning, but ICMA started as an organization of 19 bond dealers in N.M. Rothschild and Sons London office in 1968. And of course, today it has members from 62 countries. Since its founding, ICMA has lived through many firsts. The first floating rate note in 1970, the first bond deal in 1979, the first swap, formal swap in 1981, the first global bond in 1989, the first credit default swap in 1994, the first plain vanilla green bond in 2008. ICMA has grown as the markets have added size, depth, reach, diversity of products, and market participants. ICMA has indeed, as others have said, promoted the highest standards of market practice, advocated appropriate regulation, provided training, and enhanced collaboration amongst market participants. So join me in celebrating ICMA for its contribution to a well-functioning international capital markets. Today, I've chosen to speak about leveraging the capital markets for sustainable development. Our World Bank Group economists forecast that global growth over the next 3 years will average about 3%, while advanced economies will contribute on average 2%. The growth that we'll see from emerging market countries is at least 4.5%. So evidently, global growth is going to come from emerging markets, which of course rely on development finance. From an investor's perspective, emerging markets often offer high returns on a risk-adjusted basis, as well as opportunities for diversification. We believe that the opportunities abound across many emerging market sectors. To foster growth, we need to connect investors to products that build human and physical capital. We need to fill infrastructure gaps and improve health and education outcomes. And like the previous speaker said, we need to increase female labor force participation. The UN estimates that of the $3.9 trillion needed annually for developing countries to meet the Sustainable Development Goals, only $2.5 trillion is being invested per year. This means that we need to bridge this $1.4 trillion annual gap. And I believe that we can do so by leveraging the capital markets to complement what the public sector resources already does. I believe specifically we can mobilize more private sector resources. We can focus more on sustainability, as earlier speakers have alluded to. And I think we need to continue to think about innovative financing solutions. We need to tackle sustainable development with a sense of urgency. And I do believe that there's a lot from my experience in the past 50 years that we can learn from. Let me start with the World Bank. Our first bond issuance was in 1947. 70 years ago. Because of the capital markets, we can do so much in development assistance. Let me be more specific. Our shareholders have paid in only $19 billion for IBRD, the flagship institution of the World Bank, and for IFC, the private sector arm. And together, cumulatively, IFC and IBRD have provided $1.5 trillion of financing for development in real terms. If that doesn't impress you, let me remind you that our first loan was to France in 1947 as well. And this loan was, of course, funded by that first bond issue. There are other advanced nations today that those early days supported. One example that I like to often cite is Singapore. Singapore in 1963, when it took its first loan from the World Bank, had a GDP per capita of $1,000. And of course, today, it has a GDP per capita of more than $50,000. Those early days, of course, laid the path for development. But I'll also argue that it tells us what the possibilities are for the countries that are our clients today, the middle-income countries, the low-income countries. And today, we raise funds globally for all these countries. We also, as many of you may have seen, we launched another World Bank entity, the International Development Association, into the capital markets in April last month with a very successful $1.5 billion transaction that many of you supported us with. I mention this because the International Development Association, IDA, lends to low-income countries in Africa, in Asia, and in Latin America. Since it was founded in 1960, it had solely depended on shareholder funds and internally generated funds. So going to the capital markets is transformative. And watch that space, because you'll probably see other development agencies that haven't focused on the capital markets go to the capital markets. We're, of course, seeking other ways in which we can attract what I hear is about $160 trillion of assets under management. And we want to attract the assets that people manage to the profitable and sustainable opportunities in developing countries. MDBs, as many of you know, since you work with many of us, provide such opportunities because we de-risk your investments because we're a partner and we have experience in developing countries. Let me cite an example. We assisted a euro 20 billion public-private partnership program for Turkey's health sector. This PPP comprises 50 projects that, when completed, will overhaul and modernize Turkey's healthcare system. Involving the capital markets, in my view, has been key. For example, in one PPP project, the European Bank for Reconstruction and Development, EBRD, and the Multilateral Investment Guarantee Agency of the World Bank provided credit enhancement for a 288 million green bond that funded a state-of-the-art hospital. The enhancements raised the bond's credit rating 2 notches above Turkey's sovereign rating, which made it even more attractive to fixed-income investors. As other speakers have pointed out about sustainability, many investors today are integrating environmental, social, and governance factors into their decision-making. Specifically, investors are looking at how they can connect financial returns with purpose. We see this focus on sustainable investments amongst retail investors and institutional investors alike. We believe that it's even going to become more so in the future as millennials, who are set to inherit $30 trillion from their baby boom parents, become more involved in these decisions. Also crucial is what everybody who had spoken about the green bond markets said earlier, which is the success of the green bond market. I believe that it demonstrates market appetite for sustainable financial products. When the MDB started issuing green bonds, it was just MDBs. Today you have utilities, you have corporates, you have municipalities, you have sovereign issuers, many of them emerging market issuers, who have decided that the green bond market is an extremely important market. And as everybody has pointed out, the green bond principles, which ICMA is the secretariat for, has been instrumental to the growth of the market. I do believe that we can replicate the success that we've seen with green bonds for other types of sustainable investment products. And I'm glad that ICMA has already issued the social bond principles in 2016, which the chairperson of ICMA mentioned. We're indeed seeing growing interest from investors. We have done a variety of transactions, some of them focused on promoting the several SDGs, some focused on promoting one SDG, for example, gender equality. We've done some transactions that have been linked to equities of companies that promote the SDGs. And both retail investors and institutional investors have been interested in these transactions. Currently, we're working with Seychelles to facilitate the issuance of the first ever blue bond that will promote diversity, biodiversity, sustainable fisheries, and marine planning. This, in our view, is significant evidence that sustainability offers many profitable opportunities for capital market participants. I also believe that innovation is key to scaling up and broadening the opportunities to leverage the capital markets for development. As a pioneer board member of the International Financing Facility for Immunization, which was founded in 2006, I saw firsthand the power of capital markets to bring immunization to the poorest 71 countries of the world. And I know Rene Casenti, the president of ICMA and former chairman of IFIM, as well as Cyrus, who chaired one of the earlier panels, share this sentiment. And many of those who've been involved in the many transactions that IFIM has done over the years. Together, on the back of long-term commitments from donor countries, we've been able, the World Bank as treasury manager and the board of IFIM, been able to raise $5.7 billion in the capital markets. IFIM investors have liked that vaccine bonds allow them to earn a market return, but also that they can focus on purpose, on an impact-based investment. We've also leveraged the capital markets to tackle climate issues. You will agree with me that extreme weather events are one of the difficult challenges of our time. Every year, extreme weather events force about 26 million people into poverty and cost, in our estimate, over $300 billion. What are we doing? We're connecting and matching investors that are looking for yield and diversification with developing countries that are seeking protection from these extreme weather events. To date, we've done about $3.9 billion of transactions, of which $2 billion of them have been in the last 10 months. So let me give you an example. In February, we launched a $1.36 billion transaction for the Pacific Alliance countries, Chile, Colombia, Peru, Mexico, to help them with protection against earthquake and hurricane. This was the largest transaction ever in terms of transfer of sovereign risk to the CAD bond markets. Many of you are aware also that last year the World Bank launched the first global pandemic bond. The $425 million transaction was the first time that pandemic risk in low-income countries was transferred to the financial markets. The bond offered CAD bond investors a high-yielding instrument. At the same time, it channels surge funding to developing countries that face the risk of a pandemic. We believe that this demonstrates that capital markets can also address the most difficult challenges, and people can earn a profit doing that. I've shared these examples really to encourage each one of us to think about innovation that will enable you profit, but also engage in developing countries. Looking forward, we must search for game-changing opportunities to leverage the capital markets for sustainable development. Indeed, I'm inspired by the Fosbury flop. Who's familiar with the Fosbury flop? Okay. There are a few people, so please help me tell the others. if I don't describe it enough correctly. The Fosbury flop is a high jump technique named after Dick Fosbury, who won the 1968 Olympics. And we chose this example because, of course, this is the 50th anniversary of that feat. Even more significant for me is that his technique had never been used before. But since 1968, it's been used to set every new world record and to win every Olympic. It was game-changing for this sport. If I haven't encouraged you enough to think critically about game-changing opportunities, let me also remind you that the founding of the Bretton Woods system was game-changing because it launched the world into the longest period of global peace and prosperity. And I can say to you that the capital markets was instrumental, because I know for sure that none of the MDBs, not us, the World Bank Group, could have done the things we've been able to do without the support of many of you in this room and without the capital markets as an instrument of that success. To conclude, I believe, and you'll know why I'm talking about game-changing, that the next game-changing action has to focus on how we end global poverty in our lifetime, within our generation. Ending global poverty is key in an interconnected world. Indeed, Eugene Meyer, the World Bank's first president, said in 1946 that prosperity, like peace, must be viewed as indivisible. And even from the narrowest consideration of self-interest, each of us must be concerned with the economic development of the world as a whole. For we shall prosper individually only as we prosper collectively. Please, let's work together to end global poverty. And I can assure you, you will still make lots of money. Thank you.